Good morning, everyone. Very happy to be here. My name is Jorgen Ouaknine. I'm the Global Head of Innovation and Digital Assets for Euroclear. Euroclear is a major financial market infrastructure. We hold more than 40 trillions of assets under custody, and we try to figure out how to remain relevant in a space where there's a lot of competition and where tokenization is changing the game. And I'm super excited to be here on stage today with Justin, Ben, and Lior. They will introduce themselves quite shortly, and we have actually a fun job to do in half an hour. You know, I'm sure that if you actually listen to the panel, you turn off your phone or your laptop, you'll see that you'll miss the headline. You know, someone acquiring someone else, new press release out there, and we're trying to figure out how we can basically separate the real tokenization use cases from the marketing stories there. So let's just jump in the topic, and my first question is to all of you. Just give us a quick intro about yourself, what you're doing, and as well a little bit, you know, a word or a sentence that would describe your current state in this digital asset space. Justin.
Thank you very much, and thank you for having me here today. This is great. My name is Justin Cohen. I work at JP Morgan. I look after the product and platform space in our markets division for equity derivatives, our strategic index business, and our crypto offerings. And my opinions here today are my own and not those of JP Morgan's.
And what's your mind at? What's your mood today?
My mood is excellent. Look, we'll get into the conversation, but we're very interested and active in this space and looking to discuss it today.
Ben, you're up.
Yeah, great to be here. My name's Ben Forman. I'm the founder and managing partner of ParaFi Capital. We manage about $2.5 billion AUM, investing across public and private markets in crypto. Have been around for 7 years, and really the firm was founded out of this obsession of bridging traditional markets to blockchains. So we've been one of the earliest and largest investors in areas like stablecoins, real-world asset tokenization, prediction markets, DeFi. We're one of the first users of these on-chain protocols, and you know, really excited to be here and talk about tokenization. I think your question was, what's one phrase or word that summarizes where we are today? I think I would say convergence, and you know, it's interesting to reflect on just how this industry has evolved, because if we were in this room 3-4 years ago, people would be talking about, you know, the metaverse, blockchain gaming, DAOs, self-sovereign internet states. By and large, all that stuff is kind of dead or hasn't really worked. And the conversation today is all about finance. So, you know, tokenization, on-chain trading, institutions using blockchains, stable coins, and most of the people here are kind of like in traditional finance, or they're building fintech applications. So I think these two worlds are converging, and I think that like aptly kind of summarizes the mood and where things are today.
Thanks, Lior.
Hi everyone, thank you for this one. Test. Okay. All right, second time. Hi everyone. So my name is Lior Lamesh. I'm co-founder and CEO at GK8 by Galaxy. We're a Galaxy company and Nasdaq-listed company, market leaders in digital assets and AI. GK8, we started with our mission in 2018 with the focus of increasing the level of trust in the market by providing the most secure self-custody technology. We are utilizing two core solutions, one of them called Impenetrable Vault, which is our technology to do blockchain communication without being connected to the internet, alongside MPC for automated transactions. So we're partnering with TradeFi companies and large crypto-native companies and enabling them to do services such as custody, tokenization, DeFi, staking, and more. We are working with DTCC, BDAX, which is one of the regulated custodians in Korea, eToro, and about this topic with All Unity, which is the fully regulated Euro stablecoin projects out of mainly Germany and Europe. And about my mood, so we are mainly in the mood of increasing the trust by educating about the security risk that's associated with tokenization specifically. And we'll get into that.
Thanks a lot. And as you see, we have a very diverse group here, covering a big part of the ecosystem. And if we look back, over the last few years, we have seen many kind of siloed initiative happening. A lot of fragmentation took place. And, everyone is in a specific race trying to basically see, which part of the ecosystem they can bring on chain, or how they're able to do that. But unfortunately, this has still led to more fragmentation, and we haven't seen yet, the big adoption. If you look at any kind of report out there about tokenization, they talk about, a few trillions over the year, but we still are seeing that, it's definitely progressing, but there's a long way to go. So maybe, could you summarize a little bit, in your own industry, what are the major things that happened over the last 12 to 18 months, just, to set a little bit the scene?
Sure, happy to do that. So, look, JP Morgan has been very active in this space since 2020, 2021 timeframe. We were the first and only bank AP for BITO ETF, for IBIT ETF. We've issued a large number of OTC derivatives on those securities. We've been clearing the BTC future on CME since 2017, and so on and so forth. I think when it comes to tokenization of securities, this is near and dear to our heart, because the truth of the matter is that much of the financial market infrastructure is in excess of 50 years old. It's hard to argue that there are few or limited opportunities for improvement in that infrastructure, and I think tokenization offers an opportunity to really materialize those advancements. But in order to do that, we have to overcome some of the challenges that have become particularly or acutely present in the past 12 to 18 months. So as the capital model and treatment of these securities is changing through the bank system, through the various prudential regulators and the like, and the securities market has become more active in crypto, so we have sort of this hybrid space, things like the SEC approving in-kind redemption for IBIT, which is a major advancement. What's become clear is that there are three major areas that need to be addressed for tokenization to really be successful. The first of those is legal in nature. It's really about issuance. How do new securities come to be? How do those happen with good order? And how do those represent the actual entities and financial conditions that are expressed in a traditional prospectus, and so on and so forth? That's the first sort of question. The second is really about microstructure. How does good trading and good order take hold in a decentralized way? All right. Today we have a broker intermediated market, and brokers are held broadly responsible for affecting good order in markets, whether it's best execution, Reg NMS, Reg ATS, Reg Show, all these other things. Those things don't exist today in the digital asset universe. But in order to introduce ever more institutional money, they must be established. And then the third is on the operational side. So some of that is security, which it's great that there is excellent advancement there. How do you actually sustain the assets that you hold? But there are also other things. How do you operationalize things like corporate actions, dividend payments, in the absence of a singular master record, whether it's through Euroclear or through DTCC or the like? And those things really need to be addressed. So it's great that the security side is being addressed and that there's innovation there. It's great that the processing throughput rate has improved markedly in the past 12 to 18 months, advancements in Ethereum, blockchain, and so on and so forth. All of those things are critical developments, but really to get the advancement that I think everyone in this room is looking for and that we are looking for as well, we need to address all three topics.
As technology providers, I very much agree with Justin. Eventually, what we see in the last 12 to 18 months in the environment become more and more regulated, and there are more clear requirements, either in Europe with MiCA, DORA, or here with tokenization on the Genius Act as an example. We need to ensure that we, although we don't need to be regulated ourselves, we need to ensure that our clients and the institutions that working with our solution are comply with the regulation requirements. So it required us as technology provider to develop different capabilities and procedures, things around the ability to do segregation of accounts between the institution assets to its clients' assets, penetration tests on an annual basis, certain type of audits that being supported, and even more specifically, when it comes to tokenization, there are certain control levels that are required. So if in the past with crypto custody, we just needed to do a policy engine that enable things such as whitelists and limits on assets movement level, now we needed to develop it on the smart contract level. So for example, if a project need to mint stablecoin, it need to be able to define who are the users that can do minting, how much minting they can do, and so on and so forth. So that's, I think, the main area of focus that we did in the last 18 months.
So I think there's a lot of kind of qualitative, anecdotal evidence around the growth over the past 12 to 18 months in tokenization. But I think the most powerful framing is just to look at the actual numbers behind it. So if you go back to the beginning of 2024, so about 20 months ago, there was 8 billion of tokenized assets on chain. At the end of that year, beginning of 2025, that had doubled to 16 billion. And this year in 2025, it's over doubled again to about 36 billion. So I think just objectively, this is a very fast growing part of the market. I think real world asset tokenization today in 2025 is where stablecoins were in 2020. They were getting ready for liftoff. They were in growth mode. Now, I think that the reality is not all $1 of tokenized assets does not equal $1 of tokenized assets. There are vast disparities in quality. And I could open my laptop right now, launch a smart contract on Ethereum and tokenize, the Coinbase stock in my brokerage account. That is tokenization theater. It's not real tokenization. I think what we generally look at in terms of quality is what is the velocity of a tokenized asset on chain? Are people actually using it as collateral? And I think there's some really encouraging signs of what we see in the market in terms of actual usage. So if you look at Aave Horizon, Aave is the largest decentralized borrow lending market. They've created an instance of their smart contracts totally focused around borrowing against tokenized real world assets. So think about the Janus Henderson tokenized treasury product, or BlackRock's tokenized treasury product, or Superstate's tokenized basis trade product. This market launched a few months ago, already has $400 million of tokenized collateral held in its smart contracts. So I think that's very real. I think the other interesting thing we're seeing, at least in venture markets, is tokenization of the long tail of assets. So a lot of the conversation is centered around, okay, we're tokenizing treasuries, we're tokenizing money markets. I think there are probably 30 or 40 different financial institutions doing that. The market's very crowded. It's necessary, it's interesting, but it's very crowded. I think what's arguably more interesting is teams that are tokenizing assets that do not already have established capital markets. So just as one quick example, we backed a team called Courtyard. They're tokenizing Pokemon cards and baseball cards, and you may kind of giggle. This is a $300 billion tokenized, trading cards are a $300 billion market that turns over about $30 billion of primary and secondary volume per year. And Courtyard today has about $500 million of GMV and is doing about 20 million of EBITDA. So this is a very real use case. Most people using these tokenized trading cards have no idea they're interacting with the blockchain. It's push, not pull. You don't have to convince people to do it. People are, jumping to use it because it's actually providing real value. So I think there are a lot of encouraging kind of growth vectors that we're seeing across areas like that.
So just, because you mentioned conversion and because I want to be a bit spicy this morning, you talked about the growth of the assets. So I think, we can all agree that the overall crypto market is like 4 trillion, and most of half of it is Bitcoin. If you look at the growth of incumbents, and I'll take our example for exact figures. If you look at the growth of our asset under custody over the 4 or 5 years, it's more than 6 trillion. It just, puts a bit perspective in terms of the urgency to go now, and, going back to the use case, which is the core of the debate that we're going to go into now, beyond all these headlines, and, what are the real tokenization use case that had measurable impact in terms of efficiency, scalability, and adoptions, and then, what are the tokenization stories, that are creating some distraction. Maybe we'll start with Lior.
Sure. So the main real-life use cases that we are experiencing and involving in some of the high-profile ones are around currently stable coins and money market fund. I mentioned briefly at the beginning about our participation in All Unity. All Unity is a joint venture of Galaxy, DWS, formerly the treasury arm of Deutsche Bank, and Flow Traders. And GK8 is providing the full technology stack for the tokenization and the custody of that. Basically, what we do is 3 main things. We do the issuance process, which means that they can issue the stablecoin of the smart contract directly to the blockchain, utilizing the impenetrable vault in a completely offline way. The management of the admin key to do minting and burning securely, and then the custody of the tokenized assets. But I really think it's, from what we see, it's not necessarily only about the instruments themselves, but there are some, I would say, key success factors that really make tokenization use cases succeed. The first one that we see is the involvement of, I would say, a traditional partner that already done that in a trustful way in the traditional assets world. Someone who already know how to do it in the traditional world, and have this trust is a crucial piece in order to encourage other entities to follow that. The second thing is a trusted partner on the digital asset space, so someone who already has roots in the space and already has the needed connection and the know-how, and really know how to bridge the gap between the traditional institutions to the digital assets. An example for that is Galaxy. Right, so we do liquidity and distribution, and we have the know-how from a regulatory perspective to enable things happen, and a lot of connections with different foundations, so we can really bring in smart money to these projects in advance to the launching, so we kind of ensuring its success from TVL perspective before it even starts. So yeah. That's how we see, and the third point, obviously, is the technology provider, the technology partner, I would say, which, as we do with All Unity, providing things such as the custody and the tokenization infrastructure.
Thanks a lot. Ben, you want to go next?
Sorry, what was the question?
What was the question? Yeah, so what are the real use cases that actually matter out there, with real impact when it comes to tokenization, and you look at, efficiency, scale, and adoption, and, what are the kind of tokenization stories you mentioned? And somehow you talked about Pokemon cards, which one might classify left or right. So I'm happy to have your point of view on this one.
Yeah, so I think that the kind of core use cases that we look for, well, I think we've moved to phase 2. So phase 1 was, let's tokenize these different financial assets. There are now too many different tokenized yield-bearing stablecoin assets to even keep track of. I really kind of, just to reframe it, I think the next phase is how can we embed utility in these tokenized assets that exist on chain? Because if you just hold a tokenized asset on chain, you're not doing anything with it, it's actually fundamentally not useful. And so the actual I think killer, I think if you really consolidate and kind of synthesize what crypto is good at, crypto is very good at being collateral. It's 24/7, there's no foreclosure costs, there's no perfecting liens, it can be held in a smart contract so you're not taking counterparty risk. And so if you can apply kind of this concept of pristine collateral to assets in the real world, I think that's very powerful. So using these assets in smart contracts is really our area of focus. I think there are plenty of firms that are already doing the issuance of these assets, tokenized LP stakes, tokenized carbon credits, I mean, tokenized Pokemon cards, tokenized private credit is a huge market with the, and so really like where we're focused on is the actual utility once you already have issued the asset on chain.
Do you have any specific view on what's currently overhyped?
Yeah, so I think most things generally in the tokenization space are dramatically overhyped, and most of the projects that have said, hey, we're tokenizing assets, are really just minting a smart contract on Ethereum, but there's no one actually interacting with their tokenized assets. So they say, oh, we've tokenized like X billion dollars of assets, you know. But if you actually look at the smart contract level, there's one holder, the company itself, that tokenized the assets. Even some of the largest tokenized assets today are only held by, 50 to 100 holders. And just as context, if you look at the $36 billion market for tokenized RWAs today, those are only held by about 500,000 wallets in total. And if you further dissect that, the top, there's a power law where the top 1% of wallets holds like 95% of the 35 billion. So that kind of tells me that there are very few people actually using tokenized assets today. I think we're coming from a very, very low base. And so those are some of the areas of kind of, of excess that we see in the market where hype is a bit ahead of reality. And look, I think we get there, but I just want to be very sober about where we are today, which is it's still kind of quite early.
Thanks. Justin?
So I agree with Ben. I would frame it slightly differently, but I think the tone of our message is very similar, which is ultimately it needs to be outcome-based. What capabilities are being provided that are differentiated and are unique? And there are many in the tokenized circumstance. So for many years, JP Morgan has been using those capabilities on private chain with things like JPM Coin, which now does many billions of dollars of intraday repo. In the past, intraday repo for treasuries and fixed, for FIF type products has been really hard because moving those assets around in the traditional financial market infrastructure was hard, and you could really do it once per day. And so it was hard to do things like intraday repo. But with the capabilities, whether on private chain or with tokenized securities of some format, we were able to engineer solutions that allow people to have a high trust environment where they can see the asset that they've repoed, they can see the cash, and they don't need to have it delivered to them because they're able to see that it's there and they're able to see it's in good standing. And then it moves much more rapidly. That is one of many examples. It just happens to be a real live one today that's daily doing billions of dollars of flow. Now, there are lots of things in tokenized securities, equity assets and things like that are very similar. We could imagine a world where in a high-functioning world, there are real-world problems today like MSCI or other indices that are international in nature and settlement, they're multi-exchange, multinational, multi-time zone. Settling those assets, trading those assets, rebalancing those assets is very challenging from a microstructure perspective, from a settlement perspective, from a collateral perspective. Being able to do that in a more transparent, more fluid way will add scale and reduce complexity overall in the traditional financial marketplace, and I think they're uniquely well suited. I have this SI part of my title that's on the screen, the strategic index part. We create bespoke indices for clients and all kinds of different needs. The ability to do that in a tokenized world is much more straightforward. That's market expansionary for us. So we want to see that, and we do think that that's real. But in order to make that viable, we have to address the three topics that I highlighted in my prior comment.
So quite interestingly, there's one word that comes here quite often is the word trust. I have a feeling that, trust and resilience and security used to be, the things we were selling to the clients because that's our license to operate. Now I have Lior on the other side who's telling, yesterday you gave a speech and basically we could have changed GK8 by Euroclear or any kind of other financial institution, and we would have the same speech around trust, education, resilience. Can you maybe elaborate a bit more, how you see you as a digital asset custodian focusing on that, and together with financial institutions like us, having major custody businesses as well, converge, to quote Ben?
Sure. So, no, the way that we see the trust in the market eventually is about security, right? We still see for years that hacking events in blockchain and cryptocurrencies are reported on a monthly basis, and billions of dollars are being stolen every time. And I think it's really one of the reasons why the adoption is not as quick as it could be, also in tokenization. And when it comes to tokenization, the main security risk, the same as with crypto custody, by the way, is the private keys, right? Private keys is the one thing that make blockchain centralized. When it comes to the tokenization, the private key in this case is the admin key, the key that these projects on the administration level using in order to do the minting, the burning, updating the allow lists, enforcing some superpowers, restrictions on the business that it creates. And it's true that today the project that already running, the source of truth is not necessarily on-chain but off-chain, but yet the on-chain source of truth is coming, and we already see that stablecoin are being received as collateral in some of the DeFi protocols or the centralized exchanges in order to receive loans in crypto. So imagine what could happen if someone possessed this admin key and mint to himself as much stablecoins as he wants, and then can run away with crypto. And it's important to understand how hacker thinks, right? Hacking is a business. How much hackers will invest in order to compromise into a tokenization project? It really depends how much you can get. It's about ROI, and hackers will invest millions to steal billions. And there is a real misunderstanding today in the market, and again, lack of education, because there are few main solutions, right? There are the hot, warm wallets, which are mainly multi-sig or MPC-based, where all hackers need to do is just compromising 2 or 3 internet-connected computers, like 3 hot wallets. And based on our experience, my personal experience from my previous world, it's safe to assume that $1 million is what hackers need to invest in average in order to compromise one public internet-connected computer. So for hackers to compromise multi-sig or MPC to control the admin key and mint to himself stablecoins, you just need to invest a few millions. And then there are these cold wallets that are not necessarily cold. They're all at some point connected to the internet, either with the micro USB cables or some QR code and cameras, or thumb drive that you take from air-gapped machine to a computer that's supposed to be offline. But once you do it, it's not offline anymore. And that's why we're bringing to the market the impenetrable vault, which is our unique ability to do the full process of communication with the blockchain, including the minting, burning, and these sensitive functionalities, without ever receiving input from the internet.
Well, this should not be used as a business plan for hackers, just to be clear. Maybe, and just for the sake of time, there's another word that we have been hearing a lot today is million, billions, trillions. And all the forecasts are quite good, and I think our friends from Canton even have a podcast not called Quadrillions, because the trillions felt a bit small. And so clearly we are moving forward. The question is now, just to summarize, what's the missing piece? Just to go to the next level now.
I'll take a stab at this. I think the fundamental bottleneck is fragmentation. There are from an infrastructure standpoint, if I want to settle Apollo's private credit fund, ACRED, on Base, and then use it as collateral and borrow against it on Arbitrum, like these networks don't typically communicate with one another very well. Certain tokenized assets are issued on some chains but not others. Wallets support some but not others. It's very difficult for a user to diligence and understand all the different options out there, even how interest accrues for different tokenized yield-bearing stablecoin assets is very different. Some pay rebase and accrue in kind, others pay an actual dividend. And so there's a lot of fragmentation, and it can be very dizzying for users to actually interact with these. And I think once we figure that out, it'll be a big unlock for the space.
Thanks a lot. Justin.
Thank you. Look, I will say many years ago, the essence of these conversations was decentralization, low trust environments, low trust engineering. I for one, welcome a world where people here are talking about building high trust environments, high trust marketplaces, and high trust products. I think that is a sea change that is necessary for the advancements of the broader good of the marketplace, and that involves security, that involves utility, and that involves good order by highly skilled professionals in the marketplace. All of those things will result, hopefully, in more scale, which means a greater velocity of money over time, and I think we all want to see that.
Thanks, and Lior, the last word.
Very quickly, I couldn't agree more with Justin. I really think that the scalability will be achieved with the needed level of security, and once the assets will be as secure as the money in the bank, and that's really our mission, to build a system with trust that cannot fail thanks to that.
Well, we are at time. Thank you very much. Thank you very much for listening to Justin Cohen, Ben Forman, and Lior Lamesh. Thank you very much.